The second biggest mistake I made with my money was investing in individual companies thinking that I could outperform the market. This one has a bunch of layers to it, and I actually think this is a topic where a lot of people still disagree on this. The vast majority of people with a stock portfolio, whether they are doing it themselves or using a financial advisor, are cherry picking stocks. In this video, I'm going to tell you all about how I learned the hard way how wrong this approach is. This is part 2 of my 4-part mini series where I'm telling you about the 4 biggest investment mistakes I've ever made. If you didn't watch part 1, make sure you check out that video. I'll link to it below in the comments. At some point many years ago, I kind of had this wake up call when it came to managing my money and my investments. I don't really know what caused this. It was just like a light bulb went off in my head after years of spending my career advising the wealthiest people on how to do good tax planning and structure their investments. At some point, I just had the realization that I didn't need to be a billionaire to use these same strategies too. Now, I'll save the rest of that story for another day. But long story short, I realized what I was doing was all wrong. I had an advisor who was doing this dividend investing approach where he would buy shares in really large companies that had a history of paying high dividends. But at some point I realized that this approach just wasn't ever outperforming the S&P 500 and just didn't make sense. So I fired him. What that left me with was a stock portfolio that looked like this. So what I was left with was having all these shares in different companies that I didn't want to own anymore. But I couldn't just sell the shares because then I would have had to pay a ton of capital gains tax on the built-in appreciation in my portfolio. Even though my advisor wasn't outperforming the market, we were still making money, just not nearly as much as I could have. And I had been investing for a long time, so I had built up some pretty big taxable gains in there. Most of the stocks in my portfolio did have a net gain, but there were a few in there that had overall losses. So I did a little bit of tax loss harvesting. Tax loss harvesting, for those who don't know, is when you trigger some capital losses to offset capital gains. So I sold what I could to offset the losses, but there was still a big problem. I knew enough to know I shouldn't be using a financial advisor who wasn't outperforming the market. But I didn't know enough to realize that you yourself are also never going to outperform the market on a long-term basis. So going forward, I still kept doing stock picking. I started doing research, reviewing public filings in the SEC database, diving into the financial statements of those public companies, and buying the ones that I liked best. In a few really embarrassing cases, I even listened to what a pundit on CNBC said and bought some shares in a company that she said was a good idea. But worst of all, and I don't really know why, but I got really excited about this Chinese tech company that was listed on the NASDAQ. The minute I bought shares, the stock took off and doubled in price. So I had doubled my money in just a short period of time. I even, being the complete idiot I was at the time, called my dad to brag about this. He was nice enough to not laugh at me and just said, "That's great, honey. Just be careful there." Well, what happened pretty shortly after I had doubled my money was that there were some regulatory changes in China that caused the stock to crash. Not only did it wipe out all of my gains, I lost over 70% of my original investment. So, in this short span of time, I had invested, doubled my money, called my dad to brag about it, and then lost most of my money. This was a really valuable learning lesson and an extremely humbling experience for me. But I still own those shares today as a constant reminder to myself of the lesson I learned and how far I've come from those dumb mistakes that I made when I first started investing. I even think that my stock picking approach was worse than my advisor's and that I did a lot worse than he did, even when I took into account the fees I was paying him. Stock picking is not a smart approach. Smart investors do not cherry pick the stocks that they invest in because they understand that they cannot outperform the market on a long-term basis. How can I be so sure of this? Because smart investors understand how stock prices work and that they aren't just traded and that the share price is not just based on how well the company is run now and will be in the future. Also, any info you learn about a public company is reflected in the stock price almost immediately. The compounding benefit of index fund investing and the automatic rebalancing that happens is always going to be better than trying to keep up with it yourself. Smart investors also understand survivorship bias and how human behavior works and our inability to ever completely separate emotion from our decisions and actions. Smart investors also understand that you need to take into account things like taxes and fees, and the fact that stocks are the worst investments you should make, kicking off the lowest returns you should tolerate. I do hear people say that I'm wrong about this and that it's bad advice to say you can't outperform the market. But if you are someone who thinks that you can outperform the market on a long term basis, you should probably go start a hedge fund because you would be in the top 4% of all fund managers and quickly a billionaire if that's the case. You should also probably go out and buy a lottery ticket because the evidence shows your success likely stems from luck rather than any superior skill that you may have. And if for some reason you just are that unicorn and you're that smart and that good, you could probably make a lot more money putting your skills to a better use. I also hear people say, well, Warren Buffett can do it. Warren Buffett doesn't do stock picking, certainly not in the way you or I would. His approach is really more of a private equity style of investing, but he's doing it with public companies because that's the scale he's operating with. But even he has been very vocal about the fact that stock picking is a bad idea. He even organized a study one time to prove it. This is the mistake that I still have to deal with and probably will for many years to come. I still have tons of shares in random companies in my stock portfolio. That's because I can't just sell them all given how long I've been investing. I would have to pay well over seven figures in capital gains taxes, and I just don't want to do that. So, what I try to do is generate some tax losses when I can and sell a few shares here and there. Hopefully, at some point, I'll get it down to where I only own one stock in my portfolio. Because the only stock that I ever buy now is VOO, the Vanguard S&P 500 Index Fund. I don't believe in stock picking. Anytime I've ever done it, it didn't turn out well. Stay tuned for the next big mistake that I've made with my money.